If you like the idea of never paying tax on investment growth again, you're thinking Roth. But there are two flavors, Roth IRA and Roth 401k, and the rules are different. Today I'll break down the 2025 limits, income cutoffs, the 5-year clock, and the withdrawal rules so that you don't get dinged. Let's make Roth simple. For starters, let's dive into exactly what Roth means. So Roth refers to after-tax dollar accounts. Your contributions are after tax. And if you follow the rules, your withdrawals of the contributions and the earnings come out completely tax-free. You'll see Roth in two main places. Roth IRA that can be opened independently by yourself, and then a Roth 401k, which is likely offered through your employer. Same tax idea, but different rule books. Here are the 2025 contribution limits. For a Roth IRA, you can put $7,000 if you're under the age of 50. If you're above the age of 50, then you can do an additional catch-up contribution of an additional $1,000, making it $8,000 for the year. For the Roth 401k, it's going to be $23,500 for the year. Keep in mind that often some people will mix their contributions. So of that $23,500, you can split that. Like for example, 50% Roth, 50% traditional, or a 100% Roth, or 100% traditional. So this $23,500 is always the ceiling. If you're above the age of 50, you can make an additional catch-up contribution. The standard catch-up contribution is an additional $7,500, totaling it now at $31,000 for the year. Now, here's a caveat that was recently introduced. There's an additional super catch-up contribution for those who are age 60 to 63. This is going to equal 150% of the original catch-up contribution. So all in, you can put an additional $11,250. Keep in mind, you need to read through your plan rules to make sure that this is allowed. Having said that, there's one key distinction between a Roth IRA and a Roth 401k. This is where your income matters. So if your income exceeds the number on the screen here, then you can't directly open up and contribute to a Roth IRA. Now, for the Roth 401k, there are no income phase-outs, meaning you could make $3 million, $5 million, it doesn't matter your income amount, you can always contribute to a Roth 401k. Many people get this mixed up, thinking that since they can't contribute to a Roth IRA, that also means they can't do a Roth 401k, but this is not true. Now let's talk employer match. Historically, employer matches had to go in pre-tax even if you contributed as a Roth. Under Secure 2.0, employers can now utilize a Roth matching contribution. Now, keep in mind your plan can use this or they can decide not to. So check your plan rules and read through your employer benefits to see if this can be used. Now, if it is eligible, just as your normal Roth contributions are going to be taxable in this calendar year, the Roth matching contributions from your employer are also going to be taxable in this calendar year. Adoption is still rolling out here, so check your plan. Now, let's talk the 5-year clock. Specifically, there are two different 5-year clocks, and this is where people get tripped up. Now, in order for the ultimate benefit of a Roth to take place, meaning the contributions and all of the earnings come out completely tax-free, you need two qualifying elements. Number one, you must be 59 and a half at the time of withdrawal. Number two, you must have held the Roth IRA for a total of 5 tax years. So, what does that mean? That means that the first contribution, as little as just $1, starts the 5-year clock. If you decide to make that at 55, you open up a Roth IRA at 55, you contribute your first dollar. That means that even when you're 59 and a half, you cannot pull out the earnings and contributions completely tax and penalty free until you're age 60. Then you would have waited the 5 years and you would have also reached 59 and a half. Keep that in mind. Many people get confused on that. The clock starts January 1 of the year you made your first Roth contribution. Now, there's also what's called a Roth conversion. Now this means you're taking a traditional IRA or a traditional 401k, both are pre-tax, converting that into Roth dollars. This starts its own 5-year clock as well. So keep that in mind and don't get it mixed up. For conversions specifically, common strategy may be to year in, year out, make a Roth conversion. Keep in mind, every subsequent conversion has its own 5-year clock. So in other words, if you started it 5 years ago and you then decided to do a conversion every year after, the first one that you made 5 years ago has its own clock. So does the one that you did 4 years ago, 3 years ago, and so on. Now let's talk Roth 401ks. For a Roth 401k, if you start a plan at your current employer, that starts the 5-year clock. If you change jobs and you open a new Roth 401k, you can take your old Roth 401k, move it to the new plan, and it will actually take the old plan's 5-year clock. Meaning if you started it 3 years ago, then you're now going to be 3 years credited in the new Roth 401k plan. Here's a wrinkle. If you have an old Roth 401k and you move it to a brand new Roth IRA, a rollover Roth IRA, now you have started a new clock. So the day that you do it starts the new clock. In contrast, if you have an existing Roth IRA and you take your old Roth 401k, move it to the existing Roth IRA, then the existing Roth IRA still maintains its original clock. So if that was open 5 years ago, let's say, then the Roth 401k dollars that are being rolled into the existing Roth IRA would be grandfathered into the time that you started the existing Roth IRA. A key difference, but a lot of people get it mixed up, and you need to double check this because it's going to have an impact whether the withdrawals are going to be taxed or penalized. Now, let's talk required minimum distributions, or RMDs. RMDs used to apply to Roth 401ks, but now with the new Secure 2.0 Act, those have been eliminated, meaning you can keep a Roth 401k existing even if you left your employer or retired, and you don't have to take a dollar out of the account. Before Secure 2.0, you used to have to roll the Roth 401k into a Roth IRA to avoid RMDs, but now you can leave the account in the 401k. One other quick caveat here on Roth IRAs. Some people think that once you fund a Roth IRA, that money is locked up. That is actually incorrect. If you max out your contribution this year and you're under the age of 50, so let's say you do $7,000, you can always take out your contributions completely tax-free and penalty-free. So that original $7,000 can come out tax-free and penalty-free. However, if you take out any earnings on that $7,000, that is when the situation changes a little bit. So understand that, and understand that a Roth IRA technically is a liquid account from a contribution standpoint. Another common question I get is, which one should I fund first? That is going to come down to your specific situation. If you're looking to put additional money above the $8,000 that the Roth IRA allows you to contribute, well then maybe you look at the Roth 401k. If you'd like to maximize both, well then of course you can utilize both options. Now keep in mind with the Roth IRA, there is an income phase out. Now, in a future video, I'll discuss something called the backdoor Roth as well as the mega backdoor Roth, where I'll discuss how you can actually utilize the Roth IRA even if you exceed the income phase out. Keep in mind that utilizing a Roth 401k will affect your taxes for this year. So if you're in your peak tax years, understand that every dollar that you contribute to a Roth 401k is going to be added to your taxable income, as opposed to if you're using a traditional 401k, which every dollar you contribute there is actually going to decrease your taxable income. Now here's some common pitfalls to avoid. Number one, confusing the 5-year rule. Remember that each Roth conversion has its own 5-year clock. So don't assume that the first one that you make is going to apply to all future ones. Each one independently has its own 5-year clock. Also, don't get confused when taking a Roth 401k, moving it to a brand new Roth IRA, and assuming that the 5-year rule has already applied. Remember, your time in the Roth 401k doesn't carry over to the Roth IRA unless the Roth IRA has already been opened, in which case that earlier start date controls. Any mistakes on these is going to trigger that 10% penalty, so make sure that you understand these rules. Number two, forgetting the income phase outs. Now these do increase a little bit year over year, but understand that at the end of the year, you need to make sure that your income falls below the Roth IRA income threshold. Number 3, overlooking the Roth employer contribution option. And also with that, understanding that any Roth contribution made by your employer becomes taxable in that calendar year to you. A Roth IRA and a Roth 401k are two of the most powerful accounts out there for retirement planning, but they are not without its confusing attributes. So understand these rules, and if you want a specific plan, feel free to reach out. Hopefully this untangled some of that Roth confusion. If it did, hit like, subscribe, share this with someone who's been meaning to start a Roth.